Hi, everybody. Hope everyone's doing okay. Welcome to Face. Hi, Stuart. How are you? Good morning, Shooter, Forex Gal, all my trading warrior brothers and sisters, including you, Shahab, even though you spell my name with a small d and then the rest are caps. You're still my brother. Maybe it's a new language from where you're from. Okay, anyway, I want to start off with this is the best team. This is the best service, and we care about you guys. How about that? Hi, Brock. So if you haven't tried at least our trial, and this is a good trial, most trials you go broke paying your attorney, right? This trial, you'll make enough money to pay any attorney if you're following this team and you're being disciplined because you have a dashboard to drive your car and navigate the markets with us. Look at this content here. You get to hear Amanda all the time. Oh, you got patterns in play. Okay, interesting. All right. And here's some of my thoughts, your hosts, a face. I've been talking about the short side of Swiss. And yesterday, you see this high? All right, so the Swiss made this high when the euro made this low. Since then, and this was like my call for a turnaround Tuesday, so probably down about 10 pips if you took it. It was a scalp. I can't get short euro here. Still think there's one more wave at least to the downside in the Dixie. It's going nowhere. It's struggling. Probably be counterintuitive to buy the Dixie on the morning of the beginning of an impeachment public hearing. But I will say this as well, as far as some dollar pairs are concerned. Amanda Sweeney's been pounding the table on the short side of yen. I actually thought we might get a third drive up here, but it's starting to really look weakened. You know, you fade Amanda at your own peril. If you don't believe me, go hang out in our members chat because she milked cable like a cow all the way down over the last several weeks before the lows, and she's pounding the table on the short side of yen. Here's something I want to talk about that I learned from Blake a week or so ago. That the peso being a funding currency, it going up would be a sign that risk off might be beginning. And talked about it last week. You know, all through this big rally we had in S&Ps, which was, you know, the peso never made a new low. It tried a few times. I remember talking to Paulie, and Paulie had this 1924 resistance. Well, we cracked it yesterday. Okay, so you look at this, and it looks pretty good. And then you even look at the weekly, and look, we're coming out of these pinch Bowley bands to the upside right here. So that's a way, you know, this looks pretty good. I haven't pulled up a monthly, and I'd really like. I wonder what Grega's count is. I'll go look it up, which is an advantage. So, you know, I come up with my own ideas and then I go to the team to try and justify them and look for I look for any evidence that what might agree with what I'm seeing here. It almost looks like we could, you know, this whole stuff. And I mean, you're right or wrong from here, you know, under 19. And why can't we go to 2040, you know, check this out again, this resistance, and why not even this over 21? Um, The S&Ps I want to talk about briefly too before I hand it over to Blake. And just one other thing, crude is really struggling up here. Had a nice little sympathy rally with the S&Ps, and it's been rounding it out. Maybe we could still get this one more pop up towards 58 and a half. But I do want to talk about the S&Ps here because we'll know something fairly important by Friday. First of all, take a picture. This was a confirmed high on drive one. This was a divergent high over on drive two, although higher than ideal readings. And then yesterday here was drive three, and as you can tell, it's a second lower high on RSI. We'll see if we can fail here. They're trying to bounce it. Look at this on the 1 hour. We're holding this. I think there was something on the 4 hour we were holding. Oh, we're right there. But the point being, if we close back under this throwover line, which comes in right around 30.69, which is also the 2-week, it'd be a 2-week reversal. If by Friday we're back under this blue line, I think that seals it for a correction. And that's about the 30.70 level. And when I look at weeklies, the 2-week off number is this week here, and the close 2 weeks ago on Friday was 30.6970, which is pretty much right in line with getting back inside the megaphone line. So keep an eye on that. And I think that's enough. So we'll see if we could get the euro to come out of the hole. But Swiss, even if we bounce, okay, there's your weekly. I still think there's a chance the grand prize is here under this low. So, next support, going to try and hold here, but next support is here, right here, 93.60, 98.60, 36. That's going to take it down to here. So still bearish Swiss, which is acting weak, even though the dollar's steady, and really closely monitoring US dollar yen. I hope Amanda's right about this. We start taking out some of these trend lines back under 108.5, and watch this 108.5 level, because look at this. See here, this straight line. It was an important pivot, even though it traded on both sides of it. We start getting under there again, you'll have it breaking this trend line, and maybe what we have here is a wedge. So pay close
Isn't
attention.
that a 3 drive? I'm sorry. I was
You
just
mean right
looking.
here?
Yeah, from the lows, like one, the big move from like 104.50 up to like that would be,
This one be
yeah, that would be
one,
one, right?
and this be two,
Two. Yep.
and then three and four. It could be. I'm kind of thinking maybe this is one, because let me look at a 4 hour. It's not quite as clean as, this is, this is pretty clean. 1, 2, 3. But, we did diverge up here, and does look like kind of a false breakout. And actually, I don't know what this fib is from, but we failed from 1.618 of something at 109.38, Blake. So, not a classic 3 drive, but Amanda's pretty tough, and when she has conviction about something and keeps pounding the table, don't ignore it. So I know she's pretty negative yen here, which is kind of a contrarian trade right now. A lot of people are pretty positive. I thought we'd get to 110 once we did this.
Yeah, it's one of those things that equity markets, as they've been hitting all-time highs, you'd expect that the dollar yen and the yen would be just generally weak.
It,
And
you with we should have been at 110,
yeah,
a while
yeah,
ago.
yeah,
So
yeah. And so I think it's I was just saying in the chat room, I think it's pretty cheap insurance wise. If equities do start to pull back,
And also
you know,
the yields, Blake. So,
yeah,
we did enough up here to clean out this high, and I think we have a quality, and, no one thought yields could go up down here. And I looked at the DSI, and bonds were like, they're in the 30s. So it's not a crowded trade. A lot of people are looking for higher yields. What if we get a surprise here and this was just a correction, ABC, and now we wash out? So that too would be uh, force US dollar yen down, yen stronger, strength in yen.
yeah, definitely. If yields started to pull back. I mean, today they got hit really hard. We're recovering a little bit off the lows, but still, you know, um, the
30 year even look weaker.
yeah, I think
So,
maybe some of the selling in bonds may be over near term, as we head into the end of the year. Unless we get some breakthrough in trade, but everybody's already expecting phase one to be passed. So, hey,
yeah, see, so here's TLT,
yeah,
Blake, it's right there. So,
right.
hey, bud.
So, hey, you said something a little earlier, and I want to just make sure that we're clear here with everybody that's listening in. You said something like, hey, with Forex Analytics following our team, you make enough money to blah
Oh,
blah blah
yeah.
blah blah. But
Yeah.
you really, there are no guarantees in this market.
I know.
I just want to make sure that we're clear on that, because look, I take losses. We all take losses, and even if okay, let me just say this. Let's say I had some service where I'm like, buy this, sell that, buy this, sell that, which that's not what Forex Analytics is. It's, we point out some patterns in play, but a lot of the trades that we do is all in the chat room. The patterns in play are usually by the
Yeah,
book.
this is not a signal service. It's for
No,
discretionary traders, to have some ideas that they may want to execute.
but even if I had a service that said buy euro here, sell euro there, which we don't have, but let's say, and buy pound here, sell pound there, buy dollar yen, but and it made money 100% of the time, even if I had that, which is impossible. But let's just say I did. People will still screw it up. I've watched retail traders all for the last 20 years, and I say retail, I watch
I'm
traders,
sorry.
so just say traders just in general. But the problem is that most people get emotional. They trade on emotion. They don't, they disregard what you know others will say half the time, and then you get FOMO. So they're like, oh, uh, the euro dollar was a good buy, and that was like 300 pips ago, and now you're buying it, and then it hits the peak, for because it didn't fulfill its whatever. It's the fact of the matter is, we don't have a signal service, and even if we did, most people aren't going to follow it to a T. The way, and then that's true anywhere. I've watched it. But here's what Forex Analytics, in my opinion, is great for. It's great to help identify where the trends in or where the biases are at. So if you're looking at, like, let's say, dollar Canadian, and you're like, oh well, the basic technical analysis bias is higher, and it's been for the last couple of days. You can read through the last couple of days worth of analysis and say, okay, well, where it's been obviously a bullish bias. So where is the next resistance level? If I decide that I want to play it on the long side, where are the key resistance levels that we need to look at? Oh, look, we got the 200-day moving up right up over here, and they talked about the 200-day moving average, which might be a key resistance. So I need to start being a little careful when
Let
the
me
dollar
let me
Canadian gets.
clarify, Blake. We are all captains of our own ship. No one else is responsible for you not, crashing your ship against a rock.
Well,
So
correct, but I think Forex Analytics is a good way to identify
compass.
where the biases are at. Yeah, it's a great compass, and it'll help you,
There you go.
and heck, like I said, I get a lot of trades wrong. You know, I get some trades right. Sometimes it's where you press, you know, where you press you know, when you push a little bit, that makes all the difference in the world. You know, it's like, oh, I've got a little bit more aggressive trade here because, you know, trend is going in my direction. So, and that makes up for a couple of bad trades when you have a good trade that's really, you know, moving. So, but that's where our chat rooms really come into play, because we've got 80 to 100 people here pretty much, you know, throughout this time of the day, you know, that everybody's chatting in here. And like right now we have 99 people in there right now, and that's where we all really talk about, like, hey, what we're doing, because um frankly, a lot of us are, especially like you take people like Amanda or Polly, they're really active traders. So they are going to be in and out quite a bit. And a lot of people in there are the same way too. So, and even myself, you know, I started selling some dollar yen this morning, but I didn't, you know, you're not going to find it anywhere on Forex Analytics other than the analysis that says that, you know, we're struggling a little here with yields moving lower, which that would be the basic technical analysis this morning. Dollar yen's pushing lower, yields are dropping towards the lows of the session, blah, blah, blah. Support is at the 50% retracement, yada, yada, yada. But, you know, in the chat room, I'm like, hey, I've got a little bit of dollar yen short exposure because I do think it's cheap. I think it's cheap just in case stocks do come under pressure. We have CPI today. We have also Powell, which I don't believe that the old Humphrey Hawkins testimony, I don't think he's going to guide us too differently than what we already know. But if he, you know, is a little bit more sensitive to Donald Trump's rhetoric, you know, perhaps he is a little bit more dovish, and maybe the dollar comes in under a little bit of pressure. I look
He
at the
won't
dollar.
get as much attention by, you know, the media today with public hearings on the impeachment. It's kind of interesting that they're both happening simultaneously.
Yeah. I don't know if that's obviously a coincidence,
Yeah,
and I'm not paying really close attention to the impeachment
hearings.
hearings
Yeah,
anyway. But what I'll point out with
you
the
just
dollar
want him out
index,
of there so we could have better markets.
I just want some volatility, and it's. I mean, look at the dollar yen. I mean, or the dollar index.
I know
This is just
it's like died.
it's so like. I mean, yeah, you take. I know I went on a big rant yesterday about the euro. I
Euro.
mean, I'm just
Yeah,
sick of this. Like, just the, you know, all year. Okay, let's just take all year. 2019. We are in the euro dollar. We are in a I guess that you could say it's a 700 pip trading range from high to low, but you know, that's still very, very minor compared to most years, and it's just a grind. It's a grind, and just when you think you got the bearish case right, you know, the market rips up on you, then you think it's going to reverse, and then the market, you know, just, you know, reverts back to the trend. It's just, it's these grinding moves are just, you know, really difficult because we're all waiting on, you know, news to hit the wires to make a decision. And, you know, even then it's like the news has been half-assed. So
Forex
I
Gal likes your triangle in Dixie, and John Teramoto is late this morning. John, do you have a note from your mom? Okay, I don't know. Should we let him stay? I don't know if he brought a.
yeah, I think he's good. I think
Okay,
he's
bro.
good.
All right.
So anyway, one of the things we do have inflation, and inflation data is expected to come out a little stronger than expected. Let me pull up the data flash here. There it is. So here's data flash. So the inflation month over month is expected to tick up a couple of percentage points, and the core minus food or energy is still supposed to, you know, tick up a percentage point. So yeah, I mean, a tenth of a percent is what I should say. But watch inflation. Today is going to be a, you know, more of a I think this might actually be more the mover than than the Powell testimony, believe it
Will
or
it?
not. I think so. I think it's going to be
I'm
much more.
I'm not so sure, Blake. Not for those that were paying attention to what Powell said the previous time, which was extremely um, weird for central bank standard, not unexpected. I mean, the trend is obvious. Supposedly they were targeting core CPI, right, which is currently 2.4%. It was 2.3, it went to 2.4, so theoretically speaking, it's above target for quite some time. And last time Powell spoke, when they asked him about inflation, he said that in order for them to do something about inflation, they will need to see a significant move higher being sustained. So in essence, Powell, one way or another, said that they're completely prepared to let inflation run higher and not do anything about it. So yes, the market should move with inflation data, but I don't think that the Fed will move with inflation data.
So how about what happens if the inflation data, let's say CPI comes in below expectations? Then what does the Fed do there?
Then they have an easier excuse to stay the path
and continue to lower rates, or just keep rates unchanged?
for the time being. I don't think they're going to lower it because we haven't had something in between. So I think they might stay where they are for a very short period of time, but eventually they're going back to zero. I think there's no question about it.
Yeah. Well, I guess the thing is we'll have to see if the inflation data actually moves the needle at all. If it comes in any, outside of expectations, which the market is expecting it to tick up just a little bit. I think the other move that we should be watching here is the move in yields. And if you look at, let's go over to the 10-year really quick. Here's the 10-year, and if you look at the daily chart, we have a bear flag pattern, but we're touching the upper end of the flag this morning. You can probably draw it more like that. This is a daily chart, and I think the thing is if we for some reason break above these highs here, like let me just put in this line right here. This comes in at 129. If we break back above 129, that's going to squeeze the market a little bit, because I think the market was really expecting a much higher, a much bigger move in yields higher. And obviously, if we went the other direction, you would see yields, slump again even further. And I think that that's something that, just looking at it technically, we are below a year-long trend line, and I think a move back up here would catch the market off guard. I think a lot of people are out there selling bonds. They expect yields to move up. They have been selling bonds probably fairly aggressively. So a move back above 129 would probably reverse course a little bit there. So just something that I think we should pay attention to. And this move down in yields that we saw this morning is a little bit of a wake up call, I think, for a lot of traders right now. One of the other things I guess I should also mention is we really have to start watching the situation in Hong Kong. It seems that we're probably fairly close to China stepping in, and that is obviously something that would be very concerning to the markets. It would shake up risk appetite if we saw some more aggressive intervention efforts from China rather than just rhetoric. And I think that's something. And then one other thing that obviously is on everybody's radar too is the U.S. dollar CLP, the Chilean peso. It has just been rallying. One of the reasons why the dollar Mexican peso is strong is because this Latin America, move in the peso at all-time highs, or peso would be all-time lows. It's feeding into some of the dollar Mexican peso move, and I'm not trading the dollar Mex. I traded it yesterday as it broke through 1925. I think I bought it like once or twice, and I made money just like scalping it. Just I bought it and took money out of it real quick, just in and out. Nothing big, nothing right home about. But There's been a pretty big move here. This stalled at the 38% retracement at 1944. If you use Forex Analytics, you were notified when it hit the 1944 level. I think dips back down to 1935 are probably going to find some support, just in case you guys are looking to play it. I would think it's a little overbought right now. Intraday, you can see the 4-hour a little overbought. What I'd probably do if I was going to be trading this again today, would trade it something like this. Trade it on a dip back to the trend line and some of this consolidation. You can see some of these highs over here. I try to play it back like that on the long side, not chasing it up here. I don't think this is the right trade at the moment. So just some food for thought with those. Steve, I wanted to welcome any of your comments. I don't know if Stelios is here this morning. Stella, is he here?
I am. Good morning.
Oh, hey, good morning, Stelios. Can you tell us a little bit about Brexit this morning?
No, thanks.
Okay.
But I do have something to say about the RBNZ.
Okay. Oh, yes. Let's talk about the RBNZ. That caught a lot of traders off guard. I had no New Zealand exposure, but big move in New Zealand, and really respected, like the New Zealand yen respected its channel support big time. So what do you have to say about that?
So we had the RBNZ a few hours ago. The market was broadly expecting a 25 base point cut. It did not materialize. And for people who were in our chat room, we did talk about that. You mentioned as well, Amanda very correctly said that the risk reward was for the upside in Kiwi pairs. And I agreed with that at the time. And as it turns out, the RBNZ, they're usually quite aggressive. At this time, they decided to stand on hold, and they basically said that the economic developments since the last meeting do not warrant a change to the monetary policy, which is already stimulatory. So they are on a let's wait and see mode. But for me, it was a pretty big statement, I think, because the market, as I said before, was broadly pricing it in, and so it was a surprise. And it just shows that the RBNZ, we've said this many times before, the RBNZ is very quick to respond when the Kiwi is overvalued. They're very quick to say things about it. But now, if you look at where Kiwi dollar has been, it's near the lows of the 4-year range, so they're a bit more relaxed when it's down there. And so they decide to do that and see what happens. The interesting thing is that when they were expected to cut, a couple of meetings ago, whenever it was, they did 15 instead of 25, and now when they're expected to cut 25, they did nothing. So they're a bit erratic, I would say, but that's where they stand right now. So that's interesting, and the Kiwi obviously jumped quite a bit in response.
Yeah, and frankly, I just don't know how to trade it right now, because it's like, is China-U.S. trade deal going to get done? If it does, it should benefit the Kiwi. But how about if they just keep dragging this out? I mean, it takes two to tango in this trade war, and right now, I don't know if China's, I think they know they've got Trump where they want him, so they might be a little bit more demanding. And so it's going to be interesting. I'm not sure how to trade the Kiwi right now, but
and Trump did say also that if there is no deal, there's going to be much bigger tariffs coming, etc. So he's threatening.
Of course, yeah.
Steve showed the Kiwi yesterday. The right shoulder was sitting right on it, so probably. Oh, there it is. Okay, you have it up, Blake. So it was the same thing. The right shoulder down there in Kiwi.
Oh yeah.
Yeah, right there.
Do an inverted head and shoulder pattern.
Yeah,
it's still valid. Well, Steve, Stelios, I'm gonna pass it over to you guys. Good luck today, everybody, and I'll see you guys in the chat room.
Good hunting today,
Thank
Blake.
you, Blake.
Thanks.
Thank you, Blaker.
Okay, so we have.
Thank you, Pipzar.
So we have around 20 seconds till CPI.
Hi, Greek czars.
Hello, Dale.
You guys are czars. Oh, they're in Russia anyway, czars, right?
Yeah, true.
Yeah.
Okay,
anyway.
so 5 seconds to go. Let's see what we have.
Let me pull it here. There you go. The data flash. Let's see what we get. There you go. 0.4 versus 0.3.
uh,
The year-on-year at 2.3.
Yeah, CPI year-on-year is slightly better. Core CPI is slightly worse. So I think it's a non-event,
More or less, yes.
unfortunately.
another one.
Anyhow, Stelio, as yeah, as I said,
Another non-event.
as I said before, I think it's more than obvious, and we've been saying that for a long time. The Fed is just bark and no bite. I mean, okay, inflation is above target, so what are they going to do about it? Raise rates? No chance. There is no chance they're going to fight inflation. So the only thing they can keep doing is claim that,
Jawbone.
yeah, not only that, but also claim that having higher inflation for a period of time is good.
Great. Yeah, it's great.
Yeah, it's good. That's why they have started some time ago using the term symmetrical, because the general concept behind it is, oh, we had a period of time that inflation was below our target, so why not have a period of time that inflation is going to be above our target? Because there was
It's
a period.
obtuse.
There was a period of time that citizens were suffering because their cost of living was not increasing fast enough. And, now it's finally time for them to be happy that their cost of living is going to be increasing more.
Yeah, and they'll get a $5 per month raise on a COLA on their Social Security for 30, 40, $50 in price increases. Let's all do cartwheels.
So,
Sorry,
so,
Steve, you lost your train of thought.
No worries. I actually lost my train of thought because I'm trying to find where the
You
hell.
just saved 20 minutes of Steve talking. Thank you, Dale.
I'm trying to find where the hell the chat window disappeared, and it doesn't seem
Ooh,
to wanna.
Steve, look at that Gothic scene that you have there. It's like from another world.
Here, yeah.
Show that again. I feel like I'm traveling in the universe when I see your screensaver.
Looks like my kid's room, actually.
Oh, really? They want to be astronauts? Your girls? Huh?
Yeah.
First girls to Mars?
Finally found it. Okay.
You wouldn't let him go to Mars, would you? I know Steve would let Jason go, but I know you, Stell, you wouldn't let your girls go.
For some peace and quiet, I'd do it.
A long trip.
That was a good one.
Yeah.
Even further away than Mars, right? So, Stelio, did we have anything else?
Yes, just one little thing. We had some UK data. So it was another sea of red. So we had CPI, RPI, PPI input, all those indicators. CPI, obviously the main one, came in 1.5% year on year, down from 1.7, and
yeah, I think the 3-year low or something.
Yes. It's I think at this time, as we've said before, data or small data are not going to really matter.
Indeed, and we can see this on the daily chart. I mean, the pound has barely moved today. Euro also the same, although it moved lower yesterday. Seems much heavier. Pound still seems constructive. I mean, still looks like this is likely a bull flag. So, I think it's a very good likelihood that we're going to get, as it seems, pound has stopped responding to negative data. But, once we get something good having to do with the possibility of some type of Brexit taking place, I'm pretty sure it's going to shoot higher once again. Now, having to do with what you mentioned before, Coach, of course, I wanted to start by having a look at 3-4 of the Kiwi pairs. If you remember, and you do remember, you mentioned it before, we said yesterday that it's moment of truth for the Kiwi to decide if it actually wants to, form this right shoulder or if it wants to break down from that ascending trend line. It decided to do the former, and we are almost back at the neckline. So
Yep.
I would have to say that the only thing that's missing now from the mix is to see dollar, turn lower once again, because with the RBNZ being out of the way and being less dovish than the market expected, once we see dollar turn lower, if it does, I think that the Kiwi is going to slice through the 64.25 confluence of resistances, and then we're going to see some type of a squeeze taking place here. So, it's all about 64.25, a daily close above it, and there it is. Now, the Aussie Kiwi, we mentioned, if you remember, a couple of days ago that the Aussie Kiwi got rejected from this ascending channel, and today's move lower
Yeah.
is, I think, is proof.
Ugly.
Yeah, is proof that this was actually, a major rejection and not just like a, short-term thing there. So,
And you
I,
pointed out the potential failure of Aussie Kiwi the other day, Steve, and that was a home run ball last night. I mean, we had 2 huge down days on that this week, Aussie Kiwi.
yeah, we did. I mean, nothing. I mean, yeah, the day before yesterday, but
Yeah.
today is
Oh,
like,
yeah.
especially for this type of a pair, which has low volatility traditionally, because it's one currency pair against
That's
another
the
one.
biggest candle in months.
Yeah, I mean, it is a very, very big candle, and most probably it's going to find continuation. As you
It
see,
looks more like a stick of dynamite than
yeah, something like that.
a
As you see,
candle.
we're currently testing previous lows here, so we might take a breather somewhere here, but it looks like it will end up producing more follow through in the days ahead. The RSI was also diverging, so quite a nice signal there. Now, the Euro Kiwi and the Pound Kiwi, because obviously they also moved. So here's the Euro Kiwi. We were talking about the Euro Kiwi, saying that it had broken below this ascending wedge, but it was still trapped within the symmetrical triangle. Yesterday's move was quite nice, brought us back to the middle of the triangle and some horizontal support area. I mean, we still need to move further to get some big signal here, but definitely a nice move, and having to do with the pound against the Kiwi. There it is, pound against the Kiwi. In essence, brought us back to this support area. So who knows? The bullish case scenario now becomes a little bit more complex, only if this is the type of a triangle. I mean, it was looking like we had already broken above a corrective move. Now the path higher, if there is one, has to start from here, because now we're testing once again previous highs, as you see here and there, and previous lows. This is clearly horizontal support area. Also a very strong psychological level. It's 2, right? A very round number. So, if you like it higher, this is where you buy it. But if we do break and close below 2, I think then we're looking for a deeper corrective move. Don't forget, the big picture here is that we do remain trapped within this longer term ascending channel. I mean, it dates back to summer of 2016, right? And either we break higher or lower, we're still going to be within that. Now, one more, also the Kiwi against the yen, and we can throw as a bonus the Kiwi against the CAD. So here's the Kiwi against the yen. Kiwi against the yen, trapped in this consolidation. I'm still monitoring this ascending channel. So we've held support here multiple times. So I find it likely that we're going to end up making another move towards the 61.8% fib at 70.60. Regardless, this 69 area is a decision area, right? Quite a strong support. RSI also points more likely to a bullish continuation. I mean, you can see this trend line here. And you can see also that this consolidation has just worked out over both conditions. So Kiwi against the yen doesn't seem in a rush to, go anywhere fast, but I do think that higher might be the way to go. And now the Kiwi against the CAD, we saw this the other day because there was a friend here on the webinar that asked about it. So, I drew this triangle, said that, I wouldn't be doing something with it, but, now that it's retesting the triangle, it might shoot higher towards 86. And that's what it has done, right? You can see that was an important horizontal support area. We briefly breached below it. So, we might actually end up making that move towards 86, 86.20. Okay. So this is a fast overview of, the Kiwi pair, since the only real mover of the day has been the Kiwi. Now, I wanted to mention something, Dale, because you said that, you still like the USD Swiss to the downside because despite dollar not doing much and euro not doing much, it's moving lower. First of all, I agree with that. I mean, I still want to see USD Swiss lower, but I wanted to say that the reason this is happening is purely and clearly this. This is the Euro Swiss. So the Euro USD hasn't been doing anything really today, but look at the Euro Swiss last time we looked at it. I marked this point.
So why is this happening, Steve? I mean, I just trade the charts and it had me bearish Swiss. I didn't even look at Euro Swiss. Why is this happening? Why is this action happening in Euro Swiss? That's pressuring US dollar. Swiss.
I think things are quite clear. I'm in contact with people that have money and
Yeah.
manage money, and I don't think there are many investors that actually know what they're doing, that don't
So they just want to own Swiss? Is that it?
they don't expect some type of a bearish move, a big bearish move, worst case scenario, by the end of next year. I mean, best case scenario, let's say they manage to postpone the inevitable until the US elections. But,
Okay.
so
So this is an expression of risk on.
risk off.
Off.
Euro Swiss moving lower, yes. So in
Okay.
essence, there is a
I got it.
flight to the Swiss franc, right?
It's
And
like a
the
flight
only
to quality.
Yeah, it's a
type of-
flight to quality. And the only reason the
Got it.
Euro Swiss is not lower is, as we know very well, is because the S&P keeps constantly intervening in the markets, right? So I know that the path lower is not an easy one, but as you see, since we retested 120, it is a clear one-way street. I mean, we see moves to the downside. We see then consolidation periods, moves to the downside, consolidation periods, rinse and repeat. And that was an expanding triangle. We hit resistance, we got rejected from there, and we're once again moving towards that 1083 area. So as long as the Euro Swiss is going to remain under pressure, the USD Swiss is going to be moving lower more than the Euro USD is going to be moving higher. And we're clearly here in a consolidation in the USD Swiss. But I also favor a move to the downside. And the good thing here is that we have a very clear level to watch. And that's 98.40. A break below 98.40, I think will inevitably lead to the next objective, which is that low at 96.60. Maybe failing confidence in Deutsche Bank, says Barak. Yeah, I mean, I've kept warning people to stay away from Deutsche Bank because I see a lot of people trying to catch a falling knife in Deutsche Bank. And here is Deutsche Bank. It has had, after a long time, a period of consolidation, right? Here it is. You can see it here. But this looks to me as I said, this is a period of consolidation, and usually consolidations get resolved to the direction of the trend. And a testament to that, of course, somebody can say, okay, why isn't this some type of an attempt to make like a rounded bottom or whatever? The answer is it can be, but let's go back a little bit in history and see how many consolidations patterns we've had in this move lower in Deutsche Bank, and do you see any of them being resolved to the upside? So why would it be different this time? Trend is your friend. And yeah, I do think that, there is a much better likelihood that after this period of consolidation, it's going to make another move to the downside, right? Towards, I don't know, 5. Why not? I mean, 5. Yeah, 5. If you told somebody in 2009 after the rebound with Deutsche Bank being at 80 that at some point it would be trading at single digits, they would call you crazy, right? They would call you a fool. They would tell you that that's absolutely impossible. And here we are. So, 760, 5, what's the difference? I mean, it's trading like a penny stock. It's a
How
one-way
about like
street.
Fannie Mae? What happened to Fannie Mae? No one
Oh,
thought
yeah.
she'd go to zero, right?
Oh, yeah, absolutely. Yeah, yeah. I mean,
So this is Europe's Fannie Mae.
can prove to be Lehman Brothers. Now,
Okay, Lehman, yeah.
Now, do I believe it's going to have the same ending with Lehman Brothers? No, I don't. I don't because, if that happens, there's going to be like a major crisis. So, legally, illegally, over the table, under the table, officially, unofficially, they're not going to let Deutsche Bank fail, right? You can be more or less certain about it. But one thing is for sure, the vast majority of shareholders of the old times, they've already seen their uh, their portfolio having to do with Deutsche Bank vanish, right? I mean, 10% of what it was in 2009 in 10 years, right? So it is what it is.
What do you think about this? Ben made a point about what's happening in Hong Kong. What's your thought? Do you think China's going to clamp down on this? Uh, I've heard a lot of people, I forgot the guy's name, who's a very famous guy. He thought it's going to end up being a pretty bearish event for the market, what's happening in Hong Kong. Do you see anything
The
like
problem,
that?
I think it can end up being extremely nasty. Yes, extremely nasty. The question is the following: who's going to do something about it? I mean, you're going to have all governments come out and condemn
China.
Chinese course of action. And what are they going to do about it? In my opinion, 9 out of 10 of them, absolutely nothing. They're just going to officially condemn their actions. They're just going to threaten. Some of them might, put for to save face some type of, tariffs or whatever. But it's going to be, everything is going to be minor because nobody wants to mess their own economies to save Hong Kong. Unfortunately, that's
Well,
the case.
I heard a guy say, it's terrible what's happening in Hong Kong, but this sets a stage for Taiwan, which is something the mainland China has desired since it broke away from China, that they have elections in January. And I read articles that all the Taiwanese are leaving China and coming back to Taiwan. And what he is concerned about is what's happening in Hong Kong is kind of like just a precursor or foreshadowing that China may really get desperate about Taiwan next year, especially if they're breakaway candidates or independent candidates in January win. And there are, like 40-year-old treaties that would say if if China came against Taiwan, the US is committed to defend them. So that's a different story than Hong Kong. No one has treaties with Hong Kong that if China steps in, that someone has to intervene on Hong Kong's behalf, but Taiwan, it's different.
If you're asking me what are the chances that the US is going to intervene
In Taiwan,
in Taiwan in that case,
yeah, zero.
I would have to say zero. Now, if the question is what are the chances that the US is going to intervene ahead of the elections with Trump needing a deal, I would say negative. It's more likely that he's going to intervene to help China with Taiwan.
You're probably right.
Than the opposite.
Yeah, we'll both be in landing crafts together. the
Yeah,
Chinese.
something like
And
that.
and and I know. There's no oil there. Otherwise, we'd be sending troops in to protect the oil, like we are in Syria, which is crappy oil that you can't even do anything with. Anyway, yeah. So that's something in 2020. Geopolitical risk that will increase, especially in January, if the Taiwanese elect a government that is anti-mainland. Look out for that one.
Yeah, it's going to stir things up. But as I said, do I believe we're going to see any real intervention, on behalf of anybody, like the European Union, the US? Or,
Yeah.
nah. No
Putin's
chance.
probably saying that as he is salivating over the Baltic states right now too.
Yeah, most likely. Most likely. That's how it is. That's how it is. Fortunate or unfortunate, that's the situation. I mean,
We've turned inward, so we've become kind of, in a way, isolationists, and unless it's about money. Well, all war is money, but
all war is
uh,
money. That's true.
yeah,
Yes.
yeah.
All war
Okay,
is money.
that's enough of my diatribe. So, what do you think? Did you cover S&Ps yet, Steve? I'm wondering.
No, but Nasdaq, as you see here, which I have on
Yeah.
my chart here, right on the confluence of the triple confluence of resistances here. Obviously, momentum has clearly stalled.
It's interesting. The Nasdaq has not taken out its wedge line, but in S&Ps, I have it in a throw over above it. I know you have a different line in the S&Ps. You still have it underneath too.
Yeah.
Okay.
And then a very nice triple confluence of resistance is just a little bit high.
Maybe I'm using that dotted line. Maybe that's what I'm using.
Yeah,
that it's above.
it's a different wedge, right? The dotted line makes a different wedge than the other one.
Yeah, okay, that's what it is. And they come in at what, around 3060, those broken purple horizontal lines?
This one?
Yeah.
Yeah, 1355, something like that. Yes, exactly.
Thank you, buddy.
Exactly. So, both indices at resistance here. So, it's going to be quite interesting. I have to say that from a risk reward perspective, being short here makes sense. You risk very, very little. And, and as you said, for example, 25 handles to the downside to retest that trend line, or even a move lower towards 1320 to retest the breakout area from the double top, potential double top that we had here. It is likely, right? I mean, and we can still then continue the uptrend. So something like that, even if we're looking for a bigger bullish move, something like that is likely though. So looks quite appealing as a risk reward perspective. And keep in mind, Dale, that at the same time, third index at resistance, the IWM, right? Once again, at this 160 horizontal resistance area. I mean, we've been toying around with it now for like, what, 5-6 trading days. and we've been unable to break above it. So we might get another rejection from here as well. So Nasdaq, Russell, S&P, all at resistance. As I was saying yesterday, Nikkei has already gotten rejected from its resistance a little bit earlier. FTSE, the same thing, got rejected last week from resistance. And the DAX from the rest of the indices is the only one consolidating at the highs. Perhaps, though, a little overthrow from this ascending channel. So, it remains to be seen what's going to happen from here. Going through the questions to see if we haven't covered something. Question about the Aussie yen, if it's a 3 drive. Let's have a look at it. There it is. Now, we got rejected from the 50% fib, and just as we almost touched the 200 daily moving average. Now, a quality target for the 2 legs higher would have been at 76.20, which was also conveniently a horizontal support resistance area. We didn't make it up there. So far, the move lower has been orderly. So, it's not that I have like a high conviction that we're moving higher from lower from here. We're now, back testing this area as support. So I have to say that, nice rejection there in the Aussie yen, but I don't have a strong bias at the moment. 3 drive though, yes, in the short term here, this little area here is a 3 drive, but we can just end up just retracing to 74. I mean, we've already retraced most of that. So the big question here is there more downside than that? And I think we need more evidence to say that. Question about Euro Kiwi. We already covered that, so you can check it out in the recording.
About gold? Oh, you already did gold too, right?
No. And question
Oh.
about gold, which I'm going to do now. There it is. So gold, nothing really changed here, right? We got a new low. We still remain in a formation that, in my opinion, looks corrective. So I still favor the upside. Now, does it necessarily mean that we're going to move, to new highs from right here? No, it doesn't necessarily mean that. I mean, we can even move lower towards 1430, 1420. But I think the downside in gold is limited. So, the risk reward is definitely favoring the upside. Silver has also found support at this 1660, 1670 horizontal support area. We expected this move lower. We drew that some time ago. Now, let's see if we can actually rebound from current levels. Palladium seems to be having some kind of a bounce. I think, judging from the first leg lower, that it should be corrective in the short term. I think we can easily end up seeing another leg lower in Palladium before continuing the trend, something like this. Okay. And platinum is worth noticing because it's breaking through this horizontal support area once again, testing the 200 daily moving average after getting rejected once again a few days ago from this key trend line resistance, right? So until platinum can clear through that descending trend line, there is absolutely no technical reason why you would want to be long.
And speaking of platinum, Steve, my original composition used less leverage went platinum yesterday. I brought I brought it to a jeweler, a little CD I had, and he poured platinum on it, melted it on. Anyway, you guys could hear it on iTunes anytime. It'll reverberate in your head, drive you crazy, but keep you safe. Use less leverage.
So, coach,
Want to hear it?
do we have an interview?
Yeah, one of your favorites. I invited David Jensen back to
Okay.
address, some of the unwinding and the pressure going on in some of these debt markets. So David's ready to go. He's in the house.
My favorite is Kip.
Who? Oh, Kip. Yeah.
Kip. The other day
Yeah.
he was tweeting that
Yeah.
within the next like 3-4 years the Dow is going to be at 50,000. So in his mind, there's no more business cycles ever. It's going to be a 20-year recovery or something.
Yeah, I would say that he's head bullish here. Anyway, so I like Kip, and you know what? So far, so good. We'll see. Like everything, Steve, time will tell.
Indeed.
So let's look at the flip side of the coin. That's what we do here in interviews. I mean, that's why I don't mind bringing people like Kip.
Oh, I agree with you.
I want people to hear both sides of the coin and let them make up their own mind. You know what I mean?
Yeah. I just want to remind you that like 20 years ago, we had that famous book predicting
10,000
Dow at 35,000.
Oh, yeah.
And guess what? 20 years later, we're still not there. And if you're asking me if the next move is going to be to Dow 35,000 or to Dow 15,000, I would go for
You'll take the under.
Yeah, I'll take the under. Yes.
All right. Well, okay. You and Kip are polar opposites. And that's what we need to do. Unlike our news media in the US, where one station is left all the time and one station's right all the time, we show both sides. We are true market journalists in here.
Indeed.
So anyway, thanks, Steve. And let's hear what David has to say. David, welcome back to Face. I'm going to not tell the same old joke about promotions. And I'm going to unmute you. Okay. So welcome back, David.
Good morning.
How are you?
I'm well, thank you.
Good. So good time to be talking to you as we things continue to unfold. I think you tweeted or someone tweeted that piece that what happened and what continues to happen in the Fed funds market, repo market, that those pressures are going to be magnified in December. I forgot the reasons why, but I'm really interested. You've sent me a few tweets and what's been unfolding since the last time we talked. So if you just select which you click the share button there to share your screen. See the green box?
Why don't? 1 second.
There's a pop-up menu with several options. One of them is share.
Share.
There we go. Did it work? Oh no.
You need to
start. There you go.
There you go.
There you go. So we're looking at your Twitter right now.
Very good.
Twitter messages.
Good morning, gentlemen.
Good morning. How are you, David?
I'm well, thank you.
Okay, so
I'd like to can I just go through a few slides here? What you mentioned there about the repo problem is going to get better, and I think you're referring to
worse.
Pardon me. Yeah. In December, I think you're referring to the interview with Zoltan Pozsar. Is that the one?
I'm not sure. It was the Bloomberg article.
That was Bloomberg, and he's from Credit Suisse, and he's very, very good at understanding the plumbing of the repo market. I'd like to make it. He's saying that due to window dressing issues at the end of the year and
I see.
other matters, as with last year, that there's going to be a sudden liquidity demand, and he's saying of the order of $600 billion is what he thinks that the market is short. Now I'm paraphrasing a little bit, but in round numbers, that's his number. Now I'd like just to go through some slides here and show why I think we could need a little bit more than $600 billion to.
What's $600 billion among friends, right?
Yeah, exactly. $600,000 million.
And David, I don't know what the screen looks like for our viewers, but it shows all the slides you want to show. There you go. Okay, it was blocking the bottom.
Yeah.
Now it's back up. Okay.
Yeah.
All right. So Fred, what's Fred Flintstone saying here?
Well, this is your Fed funds rate running back to the early 1970s or 1970s. So you can see the peak there at 19%. And then
I remember it.
The cause of our malaise is this.
That was Volcker. That was intentional.
Yes, it was, because the problem.
That wasn't a liquidity crisis. They called him the liquidator.
Yeah. And he liquidated a lot of people. The problem they had there is from 1970 to 1980, the price of gold went from 35 to 850 an ounce. And they had to run rates to 19%, so roughly 9-10% above the rate of inflation, to get people out of gold and back into bonds again.
Okay.
Now they solved that problem with gold in 1987, right about, you can see my pipper there, but right about there.
Yeah.
And that's when Alan Greenspan became Fed chairman. And also the Bank of England created the LBMA, which is the world's foremost gold trading platform. And they substituted the trading of gold from using actual bullion to using promissory notes. Yeah. So they have promissory notes to deliver metal in the spot market, and they peaked at over 250 million ounces a day recently in trading. But what that did was it allowed the continual decline down to zero. That gold should have gone bananas as we're getting down here, because in reality, we're probably running about a negative 5% real rate. When you look at what inflation really is, it's 5 to 8%, something like that. We're using the old 1980 BLS model of the CPI. So we've run to very, very negative rates in reality. I know your real rates that you're seeing from the Fed are quite a bit more than that. They're saying inflation's in the 2.5% range. But anyway, so that's that slide of the continual decline. And as the interest rates declined, it led to a rapid increase in the amount of outstanding credit. And we can see here, this is all sectors in the United States economy. And you can see how it absolutely ramped here, and up here, we're at about $73 trillion. So that's 340% of GDP. The historic norm in 1970 and prior was about 150% of GDP. So in round numbers, we've got about $40 trillion of excess debt with respect to comparison to the historic norm.
Can I ask you something, David, in this whole debt picture? A lot of people believe that ground zero, of course, in 2008 were all the derivatives off housing. And people think this time it's going to be in the corporate debt market, that even though things are okay, a lot of the corporate debt is being downgraded, and a lot of that debt was used for financial engineering and stock buybacks, etc. Do you think that could be the fuse that lights a debt crisis in the corporate debt market?
Yeah, I mean, 2008, the fuse, and this is directly from one of Ben Bernanke's speeches, the fuse was actually the high yield debt market. That went off before that, and I'll show you a graph of that just in 1 second.
Okay.
But it's like what's happening now in the repo market mirrors what happened in 2008. in Q1. So I'll get to that in 2 seconds.
Sure.
But with the run up in the debt there to 73 trillion today, this is the structure of our markets out there. So we've got the repo market, and this is the value of these markets. So the repo market worth about 5 trillion, and about 4 trillion of that rolls every night. And you can see why that has everybody's attention, because if you seize up that market, you'll have a discontinuity in the financial system and a very, very quick decay. The 14 trillion is the amount of liquid money in the system. It's both physical currency, it's deposits with no holds. And the total of that is 14 trillion. It's the Austrian measure, the TMS measure. Now, some people use MZM or M1 or M2, and to varying extents, each of those undercounts or overcounts various components. I think the TMS measure, which is all the money in the system, is the best measure. And here is the Z. This is 73 trillion. It's gone up a trillion since I printed it a couple of weeks ago. But this gives you a sense here of that's the amount of liquid money in the system that's available. And there's your total amount of debt. So you've got 5 times the debt in the system. And then finally, these are interest rate sensitive derivatives in the system that are held by banks, and held by banks only. This number is tripled if you look at the other derivatives out there. But I'm looking at the stability of the banking system. Now, these rate sensitive derivatives, they're sensitive not just to interest rates themselves, but they're also sensitive to interest rate volatility. To what extent, it's not exactly clear.
What are they trying to hedge with these instruments? Everything?
Yeah, I think ultimately what these did was they pinned rates. I think they used derivatives to pin rates because it creates tremendously powerful levers to the movement of rates. But and there's certainly a goodly amount of speculation going on in there as well.
Okay.
Now, this goes back to the TMS, to the true money supply measure, and that is the blue curve here that you can see. So this is an annual rate of change. So you can see here, we looked at this one last time, but sub 5%, you're constricting the money supply. That's the annual rate of change of the outstanding money. So it's the outstanding rate of change of this $14 trillion that's in the system. And what you can see here is that constriction of the money supply for a couple of years blew up the .com market, and it blew up the high yield market and the housing market, and then everything else for the GFC. And then now here we are again since basically Q1 2017, they constricted it down into this danger zone. And the reason that it doesn't have to go negative, it used to have to go negative in the 70s and 80s to cause a monetary event, let's call it that. But the reason that it's just sub 5% right now is because of that tremendous leverage. You've got a 5-to-1 leverage of currency or cash, liquid cash in the system versus the debt market structure. So 5-to-1 leverage, that debt has to be supported and it has to be increased to continue the Fed's Ponzi bubble or speculative bubble that they've got going. Now, what happened here in 2008 with that constriction of the money supply? Now, this is out of a BIS report, but this is the leveraged loan market, and this gets back to your very good point there, Dale. And we're seeing here in Q1 2008, so this is just a quarter of the market, but we can see this is double B rated and single B rated, but this is your leveraged loan issuance in the US. And you can see here that, Bear blew up at the end of March. So this was pre-Bear, and it was pre-Lehman Brothers. Lehman, I think, blew up in August of 2008.
Okay. And so these were big downgrades.
Yeah. So you can see here, that's Europe, and here is the US. So you can see, you're up here at over $400 billion in issuance, and that constricted down to less than half of that. That market essentially was done in the first quarter. And that was, you would expect this to happen just from a logical standpoint. If you think about when you constrict money in a speculative bubble, the first to fail are the most leveraged, the most those that are the least credit worthy. As you constrict the money supply, they're dependent on the continual issuance of additional debt to roll the existing debt, continue the speculative bubble. So
I know I had my own speculative bubble.
Yeah.
And you know, in 08, and I was playing the credit game.
Yeah.
And then I remember once a housing crisis started, you know, say I'd have like a $40,000-$50,000 Amex credit limit that was cut to whatever my outstanding balance is. So, you know, credit crisis, one thing, David, they say, it also affects people that are credit worthy. They can't get credit either.
Ultimately, yeah.
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 I lived it.
They get hit last.
Yeah.
But the first to go are those that are teetering on insolvency. And you can see here that this market is ultimately what I believe is showing up in the repo market, is the problem in terms of the least credit worthy. And we'll see it here on this slide. This is the Goldman Sachs slide. And what this slide shows here is the percentage of the leveraged loan market that has its ratings of B- and below. So you can see the explosion here in the great financial crisis. But
and all these years it never got back to the 08 levels.
Never got back.
That's what's really interesting to me, because you know, I'm a technician. I go, wow, that, you know, this implies new highs to me if I just looked at a chart like this.
Yeah. Dale, this is ZIRP here. And ZIRP never solved the problems because it never took out the malstructuring of the economy. It just levered up the economy.
Wow.
And so
it's a continuation.
Yeah.
The big wave is coming.
It's coming. And you're seeing this, here's the decay, this accelerating decay. And that now this market is around $1 trillion market. So it's not the world's biggest market, but everything has its tripwire. And I think what we're seeing here is this accelerated decay here has shown up in the repo market and is reflected in the unwillingness of cash holders to lend adequately to meet the accelerating demands of the least creditworthy as the money supply was taken away. Now, just a quick note here is that the drop down to this 3% level, which we are currently at here, in terms of the increase in the money supply, taking away or declining it from a rough run rate of, let's say, 8% down to 3% since Q1 2017, has taken away roughly $1.5 trillion plus dollars out of the U.S. economy that would have been fed into it if they had continued with that loose money policy that they did there during the Obama administration. And there's an additional impact here of slowly increasing rates. When you've got $72 trillion of total debt out there, each $1 trillion of increase in interest rates creates an additional cash demand just to service the debt of about $720 billion a year. So you've got that combined impact there, is that we've had roughly $2 trillion pulled out of the economy since this tight money policy of the Fed was accelerated. So feeding from the repo market and the interventions that we're seeing there on a daily basis, what is the net impact? And this is from Northman, Sven Hendrick's work. The top one is the 10-year 3-month inversion of the yield curve. Mm-hmm. And the bottom one is the SPX, the S&P 500. And you can see here, it's not the inversion that kills you, but it's when you become uninverted again. And the
like what's happening now in the last month or so.
Exactly. And so this really feeds into the conversation you were having before I came on, is that we're now in the zone where you're having this inversion unwinding. and you're back into the area here where we should see very, very shortly the consequences of the removal of credit from the system.
Can you explain to people who believe that since the Fed got religion after December and reversed course, and now they're all the money that's being pumped in that they don't want to call QE at all, why it hasn't fixed things? Is it because of a lag in monetary policy? For people who think the Fed has corrected itself in time, what do you say?
The interventions in the repo market feed the financial market. What happens in each of these cases here, where you have a prolonged secular tightening of the money supply and removal of availability of money, is that in essence you're drying out the economy. Monetary policy takes years to impact the economy, and so what we have is a creation of credit dependency here with really, really long-term loose money policy. Runs right back to 2008. Get the horns there, and it never really got below 8% that whole time in terms of the year-over-year increase, and that creates this credit dependency and malstructuring of the economy. And so when you lower the money supply, which is the year-over-year change of the money stock, when you lower that down to this level, if you want to use the vernacular, it really is drying out the economy and drying out the availability of capital to sustain the economy. So what the Fed has done with the repo market is that they are addressing a problem in the broad economy, in the decline of creditworthiness in the entire economy, and they're addressing it by meeting liquidity requirements of the financial markets. And those are two very different things. The financial markets are very tightly focused, and it takes time for any kind of monetary intervention, which running about $3 trillion now in terms of the reversal of the Fed.
So for the real economy,
300 billion, pardon me.
For the real economy, there's a much longer lag time.
Sure.
But in financial assets, it's more reflexive to what it does.
Yeah.
Is that what you're saying?
It addresses credit shortage in the financial markets and to some extent in the broader economy, but it takes years for it to reach there. And I misspoke. I just said 3 trillion. It's about $300 billion of interventions now that the Fed have applied into the repo market. So you've got two problems here. You've got Zoltan Pozsar points out that there's roughly a $600 billion shortage to meet the liquidity requirements here of the year end of the financial industry. But what they've done ultimately by the Fed has done by tightening monetary policies, they've destabilized a portion of this $72 trillion debt bubble. And they've also destabilized the portion of this $200 trillion derivatives bubble, which is rate volatility sensitive. And so, all of these are dependent upon the creditworthiness of the players in them. And so this repo market here is really a portion. It's about a $5 trillion portion of the credit market, which rolls every night, but it's really signaling that there's a problem. The shortage here undermined the effective support of the existing debt that's in the market there, and it can knock on into this other $200 trillion portion. So I'm arguing that, as we saw in 2008, that we've got a problem which far reaches beyond the repo market itself, and it has much longer term consequences. But when this starts to let go here, you're going to have other problems in the system as well.
I have a question from one of our viewers, Brock. He'd like to know if we're going to have a bigger repo problem due to low European bank confidence. Could the weakness in Europe play into this at all?
Is he talking about the Eurodollar market feeding into this?
I think it's just European banks.
Yeah.
That the narrative was, David, we had cleaned up our act in 2008, but Europe never did. So could anything systemic happening in European banks also magnify this?
Potentially. I mean, the repo, there could be knock on into the financial markets here, but I mean, the repo market is, is a U.S. Market handling U.S. assets typically. But certainly, I mean, it's a question, I think, really of, can a domino intruding from another market reach into this market? But my argument is that, you're looking at the equity market here, but we could look at the Fed balance sheet to say that it already has reached into this market, and not from Europe itself, but ultimately, from domestic sources, from the Fed itself.
Okay. Thank
you. Yeah. So in summary, I think that the dollar shortage is possibly is likely much greater than what I think Zoltan Pozsar sees, looking strictly at the plumbing of the New York repo market itself. Now, I want to just touch on one thing, and that's the high yield market, the leveraged loan market. So leveraged loan market is lending to those who already have a lot of debt. So they're highly leveraged, and that whole market sector is called the leveraged loan market. And one of those markets is the U.S. shale industry. And what this shows here is from 2012 to currently, that U.S. shale production went from, in round numbers, about $1 trillion up to $6.5 trillion. From 6. So used to using trillions, from 6 million barrels a day, roughly up to 6.5 million barrels a day. So there, the U.S. went from a net oil importer of size to a net oil exporter, and much of that was a consequence of this cheap credit. Now, this curve here, this curve is the MZM, so that's the money zero maturity, and this money stock, its total money outstanding, the red line here is the money zero maturity.
Okay.
And the blue line here is the West Texas Intermediate oil prices. But you can see here the ramp in the money stock. Now this overcounts some elements, the MZM, but the Fed doesn't print the TMS measure, which is an Austrian measure, I believe, because it gives away exactly what their playbook is. But this MZM, although it's a little bit overstated here, you can see this ramp, and that through 2008 and on, we had the ZIRP policy in effect. But this availability of cheap money, you can see here with this, the crude oil prices collapsing, and that from this ramp up here that we experienced between 2012 and currently in terms of the shale oil production, it brought on to the market a lot of unproductive, expensive oil because there was free money in the system. And by roughly 2015, the West Texas Intermediate price collapsed as this supply of crude oil into the market collapsed the price down. I'm arguing that, using just classic economics analysis, that when you double the money stock over time, so let's say you have $1 trillion in total money, if you double that total money to 2 trillion over time, the prices of all goods and services will double as well, everything else being equal. And so what we see here is that this tracked fairly decently, that the increase in the red line, which is the money stock, that the West Texas Intermediate price did track it for a period of time, but then collapsed as this supply of shale oil hit the market and drove oil prices down. But I'm arguing that the cheap money is now going away, and we're seeing that in the repo market, and that at some point the production at the margins from these unproductive shale producers is going to go away as well, and that we're going to see much higher oil prices. And quickly, just at the end here, Chesapeake, this is their credit default swaps, and they're 500,000 barrels a day. They're 500,000 barrel a day producer, the largest in the shale patch, and they're now into trouble again. And they
their stock's under $1 now.
It is. It's in the neighborhood of 60 cents.
Yeah.
And
the penny stock, unbelievable.
Yeah. So they're in trouble now, but ultimately it all goes back, Dale, to the blowing of the credit bubble. And then just like in 1928, 29, the Fed ran rates all through the 20s there, the mid 20s, at below the rate of the Bank of England. And in the UK, they were in severe trouble after World War I. The US economy was strong, and there was quite flush. They ran loose money throughout the 1920s, and then in 28, 29, they suddenly constricted the money supply, and the consequences of that were impacted the economy at that point. And
you
I'm
know,
arguing,
David, when I was trading back then, and I still have it, I have the ticker tape under glass.
yes,
You know, that's really what a tape reader was. I'm just kidding. I just have one more question before I say goodbye to you. And what a great presentation. I mean, you open my eyes to so many things every time you're here. Dominic Rudger would like to know, how do you think they can try to stretch a rubber band further into Q1, Q2 next year, assuming correction should happen before that? What are the ways to delay it? You know, the reality of what you're showing us. Do they have any tools to stretch this out into maybe the election next year?
Well, I think you would have to look at the bank policy right now in terms of the reserves that they have to hold, and Zoltan in that Bloomberg interview, and I really think people should go back and take a look at that, but it's from about 4 or 5 days ago.
Okay.
But he said that they could lower the reserve requirements. There's statutory requirements right now that are in place that are forcing the banks to hold more reserves. And so he's saying that, you know, you could release it, you know, in round numbers, $1 trillion into the system very quickly if they remove those regulatory requirements. But he also points out that the Fed is unlikely to do that because of the criticism it would get. But it's that kind of thing that you can unleash $1 trillion into the system, you know, in a very short order, and also that would help Trump's reelection requirement. So I don't think the Fed is an apolitical institution. I'm a little bit skeptical.
You think they'll do that?
Do I think they'll loosen the regulatory requirements? No, because no.
Okay.
They'll say that this was due to deregulation, and in essence, all of our problems come from the regulators themselves.
I see.
You know, a friend of mine
pointing their finger at everyone else.
Well, a friend of mine, Larry Parks, always points out that they blame animal spirits, you know, in the markets. But what happens when the regulators get animal spirits? Nobody asks that question. And so you've got these central planners here who are doing things that are not in everybody's best interests. And ultimately, our problem arises from central planning. It arises from the regulators, the control of the money supply, and what I would really say is really malpractice that they're undertaking when they whip around the money supply in the really inadvisable way that we see that they have historically.
What a great presentation, and I'm not the only one that thinks so. Everyone's saying it in here, David. So really appreciate you bringing your work to the table for us here in FACE a couple times. And again, David, appreciate it. I learn from you every time you're here. The best way for people to follow you, is it on Twitter at Real David Jensen?
Yep, that's my
the
handle.
best way. So
yep. Real David Jensen. They can plug in there to the materials there. You can see it's down here in the lower right hand corner.
Okay, there you are. So unlike, don't go to the fake David Jensen. Go to the real one.
Absolutely.
There was a fake Dale Pinkert on Twitter this week.
Was there?
Yeah, they do it. They do that.
Must have been Heckle and Jekyll.
Yeah, you know, anyway, you know you've made it when people are using your handle. All right? It's a sign of success. Anyway, David, thank you so much. Appreciate the presentation, learning about things that I think are so damn important with what's going on here over the next couple years. So
my pleasure.
Yeah, keep up the good work. You know what you are? You're a watchman for people that are getting carried away with the hopium.
It's easy to get lost in the details, and the Fed relies on that. It's the big picture stuff that tells you what they're doing.
Well, I'll tell you what, after listening to you, every time I listen to you, I look at a shovel outside to go, I better start digging that bunker.
Yeah. Gold's looking pretty good.
It is.
Okay.
All right, David. Everyone, thank David for being with us. That's a wrap for us. We'll see everyone tomorrow. And remember, no matter what's going on with money supply, don't just count your cash, count your blessings. And we'll see everyone tomorrow. Thank you, David Jensen.
Thank you.
The real one. Adios, everyone. You're welcome, Scott, John, Monica. See everyone tomorrow.